Hi, my name is Scott Evans with Cross Country Mortgage. Thank you so much for watching this first-time homebuyer webinar. I am so excited to share all this amazing information with all of you today. Here's a little bit about myself and my team. We have over 30 years worth of mortgage experience. I'm ranked one of the top loan officers in the United States last year. I was ranked the #1 VA loan officer in 2019 and 18. But more importantly, we have closed over 17,000 transactions. I say all this, it's not to impress you, but to impress upon you. When you do something 17,000 times, you get really good at it. Wouldn't you agree? So let's dive right in. Whether you're actively looking to purchase or just considering your options, well, this is a great place to start. But very important, those watching this webinar, make sure to finish the entire webinar, because at the very end, I have some special financing incentives to all of you that finish it. So let's have a little fun before we dive into the content. I have a quick little quiz for all of you. What are 5 ways to be wealthy in the United States? First way, inherit it. Marry into it. How many of you have a rich uncle? Maybe you found a sugar mama, sugar daddy? I mean, I know we're all looking for one, but it's highly unlikely. Number 2, play the stock market. Those that know day traders or are day traders will tell you that it's very sophisticated, it's risky, and it is very time consuming. Number 3, be a business owner. Those that are watching that are business owners would agree it's a lot harder than they thought it was going to be. In fact, did you know that 90% of all small businesses fail within the first 5 years? And number 4, be an entertainer, an athlete, or win the lotto. And you would agree all those are extremely rare. And number 5, my personal favorite, owning real estate. It's the common person's way of creating wealth. In fact, did you know that 70% of the millionaires are created through owning real estate? It's easy, it's a requirement to live, and you can obtain with little to no investment. So why are we doing these webinars? I recently read a stat that was very disturbing. It said that 82% of Americans have no ability to retire. That 1 out of 3 Americans has no money saved up for retirement. In fact, it said that 18% of Americans have over $200,000 saved for retirement, and they feel that that is a viable retirement plan. So I have to ask you, what did you make last year, and how long is $200,000 gonna last you? So when people ask me what I do for a living, I don't tell them I'm a loan officer. I tell them I teach people how to win the real life game of Monopoly. And when thinking of Monopoly, you cannot win by going around collecting $200. You win by buying properties and having other people pay your rent. So when you think of a renter, they're just going around life, collecting their paycheck and paying rent. Whereas once you become a landlord and start owning more and more properties and having people pay you rent, you create a passive income. And that's my goal, is to teach you how to win the real life game of Monopoly. So with real estate, you don't wait and buy, you buy and then you wait. What do you think the biggest perceived barrier to homeownership is? You're either gonna say down payment or credit. I used to teach live seminars in front of thousands and thousands of people for the past 2 years. And literally a third to half the room would think they have to have 20% to put down in order to purchase. Well, guess what? You don't. The second myth, you need to have a perfect credit score to purchase a home. This is false. In fact, those that are watching that have VA eligibility, did you know that VA has no credit score requirement? And those that are maybe using an FHA loan, you can actually get an FHA loan with credit scores in the 500s. Then there's misinformation. Some of you might be just too scared of the process or overwhelmed on where to start, or just didn't think you had the income in order to purchase a home. These are just some of the barriers that are holding people back in obtaining the American dream and having home ownership. Down payment assistance, otherwise known as DPA. There are 2 types of programs that we're going to talk about in this webinar. The first is CalHFA, or California Housing Finance Agency. The second is the Golden State Finance Authority, or GSFA. There are other down payment assistance programs in the state of California, and most states have some type of down payment assistance program. In fact, our company can lend in all 50 states. So CalHFA, we have the CalHFA conventional loan, which the minimum down payment is 3%, or we have the CalHFA FHA loan, which the minimum down payment is 3.5% down. Both are 30-year fixed mortgages, and you can use them to buy a single-family residence, a one-unit single-family residence. You can't buy a duplex, triplex, or fourplex with these specific programs, but you can buy a manufactured home. You can buy a PUD or a planned unit development. Those are those master plan communities that you see out there. You can buy a condominium. In order to use these programs, all borrowers must be a first-time home buyer. Now, there are many ways to be considered a first-time home buyer. First way is you've never owned a home ever in your life. Pretty self-explanatory. Second way is if you owned a home and you sold that home and you've been renting for 3 years and it's been 3 years since you owned that home, you would now be considered a first-time home buyer again. And the third way is if you currently own a home and you were forced to move, maybe by your job, and you've been currently renting for 3 years, at which we can document that you've been renting and you've been renting out that home for the 3 years, then you would be considered a first-time home buyer for this particular program. The next program that comes along with CalHFA is their down payment assistance program, and it is called My Home. With My Home, you get a loan for the down payment for 3% if you're doing a conventional CalHFA conventional loan. You get a loan of 3% for the down payment. Or if you're doing an FHA, a CalHFA FHA loan, you get 3.5% from My Home to be used for the down payment. The loan amount size is based on the sales price of the home, and you can use this My Home for either down payment and or closing costs. The great thing about this loan is the payments are deferred. So you do not make a payment on this particular loan for the entire life of the loan. It's also simple interest. So you don't make any payments and you pay back the loan when you sell or refinance the loan. And the interest rate is 3%, and it's simple interest, not compound. What that means is because you're not paying on the loan, the interest is not compounding on itself. The third program that comes with CalHFA that you can use or not use is something called the ZIP, and that stands for the Zero Interest Rate Program. This comes in two different loan amount sizes, either 2% loan size or 3% loan size, and that is based on the loan amount that you obtain. As I mentioned, the interest rate is 0. The great thing about this program, it is deferred for the entire life of the loan, and you have to pay back this loan when you sell or refinance. This loan is can only be used for closing costs. So whenever you're buying a home, not only are you buying the home, then you have your down payment that goes for purchasing the home, but you also have something called closing costs, which are third-party costs, appraisals, and various other taxes and stuff like that also has to get paid. And this is CalHFA's solution to help cover those costs. So let's see how this program works. I'm going to give you guys two examples. So we're going to use a $400,000 home purchase. We're going to use a conventional loan, which the minimum down payment, remember, is 3%. So therefore, the loan that we get from CalHFA is for 97% of the purchase price, which would be $388,000. That would be the mortgage that you're paying on each month. The down payment that's needed is 3%, which is $12,000. Now we're going to use the My Home down payment assistance to be, which is 3%, to be used for the down payment. So that's 12 grand that gets applied for the down payment. Then we're going to use the ZIP program, and we're going to use the 3% ZIP, which it's The loan amount is $388 times 3%, which is $11,640, and that is going to be applied towards your closing costs. And this is how you buy a home with no money out of pocket, because you have your down payment covered, you have your closing costs covered. And the beauty is both the down payment loan, My Home, and the ZIP, you do not make any payments for the life of the loan with those programs. And this is my second example, my visual example. So essentially we stack the loans. You would get 3 loans. You have your main mortgage, the conventional loan, which requires a down payment, which we use the My Home for the down payment. And then we use the ZIP to pay for the closing costs. And we stack them together and you get 3 mortgages. And this is how you buy a home with no money down. The second down payment assistance program we're going to talk about is the GSFA, Golden State Finance Authority program. Now here you get a loan of 5% of the sales price, and this can be used for down payment and or closing costs. Now remember, the minimum down payment is 3% on a conventional loan or 3.5% on an FHA loan. The great thing about this particular loan is after owning the home for 3 years, that loan is fully forgiven and the interest rate is 0. You do not have to be a first-time home buyer in order to use this program, and you can use this in conjunction with any of the loan programs, the conventional, FHA, USDA, and the VA home loan. GSFA also has a second part of the program called the Select. And instead of actually being a loan that's forgiven after 3 years, it's forgiven immediately. And it's for people that qualify in these certain professions. If you're a peace officer, a police officer, a sheriff, a border patrol, anyone serving a correctional officer or serving in law enforcement capacity, a firefighter, CAL FIRE, paramedic, EMT, any current members of the California State Teachers Retirement System, anyone that works for the university retirement system, any public schools in the public school districts, and the list. So I provided a list of people that would qualify for this program. Credit and credit scores is the biggest topic that I receive every single day from home buyers. I did create a separate credit video, but this topic is so important that I added it to this webinar. I hope you get a lot out of this next section. This is an education on your credit and how your credit score is derived. There are 55 different algorithms that create your credit score. So a mortgage company compares it to auto, compared to credit card companies, to Credit Karma. We all have different algorithms or formulas that create the credit scores. A mortgage company, because it's the biggest debt you're ever going to incur, has the most strictest algorithm. So when you think your credit score might be here based on Credit Karma, it's typically different when you talk to a mortgage professional. Tip number 1, revolving credit or credit cards. This makes up 30% of your score. So the way that credit card companies report, they typically report when several days before your balance is due. I bring this up because it's very important to understand this. Now, when your balance to limit at the time of reporting, or in other words, going onto the credit report, if that balance to limit is over 50%, it negatively affects your score. So it's always good to keep your credit cards below 50%, ideally below 30% at all times. Now, it's okay if they goes higher. We have simulators that we can run and tell you that if you pay down a particular credit card, this is what it projects as far as where your credit score would go to. Now, it doesn't matter if you have a $5,000 credit card or a $500 credit card, they are all weighted the same. A good rule of thumb is to have at least 3 credit cards, and this is why. Because this is an algorithm, and it doesn't matter how big the credit card limits are, they're all weighted the same. So you should use one for credit card simply for gas, right? So that way you're just using it for gas. Another one maybe for groceries,
and then another one that you do the majority of your spending on. So that way, if you do spend a lot one month, you have one credit card that is over 50%, but you have two that are below the 50 or below 30%, and then they balance it out and it keeps your score high. Tip number 2 is don't be late. It's okay if you are. After 2 years, whatever you have a derogatory item on your credit, eventually it does not affect your score as if it was recent. So after 2 years of passing on a late or a collection, eventually it's not going to be affecting your score as much. Tip number 3, installment debts. A lot of times people bring up like, oh, I just got a car, that should help out my score. Installment debts like cars don't have that big of an effect on your credit as long as you're not late on that installment debt. After 12 months of having that debt, that's when it actually helps out your score, but not as much as the revolving credit cards that I mentioned previously. Tip number 4, collections or medical collections. So this is how it works. Every trade line or debt that's on your credit report, they paid money to each one of the bureaus. There are 3 bureaus. And so over time, eventually, when that collection, they get tired of paying to each one of those bureaus. So they might stop paying to this bureau to save money. They might paying to this bureau. And then eventually they just get tired. They feel that they're not gonna get the money back. So they stop reporting and paying every single month to all the different bureaus. So over time, that collection becomes an unpaid collection. One of the biggest mistakes that I find is sometimes people try to prepare and they might pay different debts off, like an unpaid collection that's over 2 years and therefore is not affecting your score as much as what happens when you paid the collection and now it's a recent paid collection and it actually brings down your score. All right, one of my personal favorites, one of the biggest myths in our industry, and that is having your credit pulled. A lot of people are concerned about having their credit pulled or having an inquiry on their credit, feeling that that will decrease their score. This was really created by the mortgage industry or loan officers to deter clients to go talk to other lenders. Think about it. Why are they going to ding your score because you had your credit pulled? Now, during a 15 to 20 day period, you can have your credit pulled as many times as you want, and it really counts as one credit inquiry. Now, if you get to 60 days, 90 days, and you've had your credit pulled by 50 different lenders, then it's going to have an effect on your credit, and it could drop your score 5 to 10 to 15 points. It's not that big of an effect. And the best tip of all is don't try to do this yourself. I am a mortgage professional. I look at thousands of credit reports every year. We can look at it instantly and give you proper advice and, more importantly, direct you to appropriate people if you need professional help with increasing your score. So don't prepare to prepare, just take action and let us look at it and we'll give you really, really good sound advice what you need to do. Timing. Is it a good time to buy? Specifically what's going on with COVID-19. So I'd like to share with you guys my insight. Prior to the pandemic, the housing market was booming. Prices were increasing while inventory was at its lowest levels in 40 years. Inventory levels should remain tight because new construction has slowed due to COVID-19. Meanwhile, demand for homeownership has been pent up and those living in apartments are looking for more space and distance. And remember, the biggest driver of home buying is having children. Many expect childbirths to increase over the next year. The homeownership rate has recently risen to 65%, with the fastest growing segment being those in their 20s. With the demand rising and supply remaining tight, home values should be well supported in the future. So let's take a look at the housing landscape for your market. So I'm gonna dive into a lot of data and I'm gonna show you why we're gonna have stable appreciation in San Diego County. I use this analogy all the time. If someone's going down the freeway going 100 miles an hour and then they slow down to 3 miles an hour, are they still moving forward? And the answer is yes. And that's what happened to the San Diego market. We are still appreciating at very safe, stable levels, and it is all based on supply and demand. The median home price in San Diego County was $643,000. The last 60 years, the appreciation was 6.24%. Last 10 years, it was 4.48%. Last 5 years was at 5.8%. And this was all during, some of the worst crisis ever. And we still, on average, appreciated, almost 5%. The forecast and projection as of right now is about 4.7% for this year. Over the next 5 years, it's at 35%. You're wondering, how did I come up with these numbers? Well, you'll see. If you bought that $643,000 home, in 5 years, that's $227,000 in appreciation gain. This is gonna be the most important information that you're gonna get from why we're gonna have stable appreciation. As you can see, there's 3.3 million people that live in San Diego County, at which 1.6 million are renters. Out of those renters, there are 300,000 renters that can buy a home right now based on government data. All your tax returns and W-2s is all government data. So we pulled these stats. When the market crashed in 2006, builders kind of finished their inventory 2006, 7, 8, and then they stopped building homes for a very long time. 2008, 2009, 10, 11, 12, 13, 14, 15. As I mentioned earlier, babies are born every single day. So someone that was 15 in 2006, well, they're 29 in 2020. So they eventually need a place to live. And the reason why people buy is, one, they get married, have a baby, they've been at their job for a while. So we need homes for them to move into. There's 300,000 renters that could be able to buy a home right now. Out of those, 51,000 are first-time home buyers, ages 27 to 35. Using around a 50% homeownership ratio of those being couples, we need around 26,000 homes to be built in San Diego County. We have 9,500 homes currently being built based on the permits pulled. So as you can see, it is simply a supply and demand. We have limited land. We have Mexico to the south. We got Camp Pendleton to the north. We got water to the west, and we got mountains to the east. More and more people keep coming to San Diego, and we don't have enough homes, and that's why there's still gonna be stable appreciation for the next few years. Now we're gonna dive in deep on a buy versus rent scenario in San Diego County. I'm gonna use a rent of $2,200, $2,206, renter's insurance of about $33. Did you know that the annual rent increase last year in San Diego County was 4.5%? The national average was 3.7%. I'm gonna compare this to a $475,000 home. We're just, in this example, using a VA loan at 2.75% with property taxes or real estate taxes of $5,600, insurance, homeowner's insurance of $70. So this totals to $2,546. So we're gonna call this PITI, or principal, interest, taxes, and insurance. Next, we compare this to the rent for the first year, which is $2,239. Now, as I mentioned, the rent increases at 4.5%. So as you can see, the rent increases over time. So in 5 years, the rent is now $2,670. So what I've done now is taking the rent over 5 years, or the buying over 5 years, what you pay over 5 years for buying, and what you pay for renting over 5 years. You see $153,000 for buying and $146,000 for renting. So at face value, you might think, oh, it's cheaper to rent. It's $7,100 difference, but you're missing some important details. The first is appreciation. As I mentioned, why we're going to have stable appreciation. So that $475,000 home now in 5 years is worth $577,000. So that's $102,000 in appreciation. Then you pay down the mortgage. That's $475,000 home is now paid it down to $418,000. That's $56,000 of principal reduction. The tax benefits, there's no tax benefits in this example. I'm actually gonna make this real and assume that you sell the home. And selling a home costs anywhere from 5 to 6%. A lot of times people think it costs money to hire a buyer's agent. It's actually, it doesn't. And I work with the top buyer's agents out there in the market. The seller's the one who actually pays for the real estate commissions. A lot of times people think if I go directly to the listing agent, I'm gonna get a better deal. Well, have you ever got divorced? Would you ever use the same divorce attorney that represents both you and the person you're getting divorced from? I mean, whose side are they on? We're gonna make this real and we're gonna assume you're selling the home. As you can see, after 5 years, you would have came out $117,000 ahead. If you notice on year one, if you only owned that home for 1 year and sold that home, you would not have come out ahead. So I do not recommend buying a home and then selling it after 1 year. But after year two, you would have made $23,000. That is buying versus renting. So before I go into the incentives that I talked about in the beginning, I want to briefly describe and talk about some of the benefits with working myself and my team. So first of all, our company can lend in all 50 states. So wherever you're looking to buy, we can be able to help you. We can also do any type of loan, not just a VA loan, any type of loan. We also close fast, right? Our average time frames on a VA loan is anywhere from 14 to 17 days. Why is that important? Because a fast close gives you a competitive advantage with getting your offer accepted. And more importantly, we have some of the best communication out there in the mortgage industry. This is the biggest home purchase you're ever gonna make, and you need to have someone holding your hand and making it a very enjoyable experience. And that's what we do. So why should you choose option B? This is what you're gonna get, the incentives. You can use these incentives anytime you want. They do not expire. So let's go into them. The first incentive. I will reimburse you for your appraisal, which is valued up to $600. That's real money. Second incentive that you're gonna get. We'll guarantee to get you a combined minimum of $3,000 in total closing costs towards your home purchase. The third incentive is the agents that we work with on this webinar will get you a free 1-year home warranty valued at $525. Fourth incentive, will help buy you out of a lease so you can own a home. This is valued over $4,125. Let me repeat that. $4,125. This is free money. All you have to do, set an appointment, get educated, fill out a simple online application, and then you can start your path to generational wealth. Remember, you only get these incentives if you take action within the next 24 hours. Thank you for watching this webinar. I look forward to helping you obtain the American dream and winning the real life game of Monopoly.